Ryan Kelly, one stock that you own in the Hennessy Gas Utility Fund is Atmos Energy. It's up around 4% so far this year. How's it going to react when the Fed finally raises rates? Because it got a little bit of a pop last week when they left the rates unchanged.
Yes, well, Atmos Energy, it's a typical company that we own. It's a local distribution company. Their earnings are driven by natural gas moving through their pipelines, the volumetric thing. So it's also being painted, though, with the same brush as other utility companies, and the idea being that in a rising interest rate environment, utilities do poorly. I think that for a lot of the companies in our fund, and for this company in particular, that's not necessarily the case. They'll continue to see natural gas move through their system and continue to grow at a small pace every year.
Another stock that's in your fund is AGL Resources. I think they're going to get bought by Southern Company. They still pay about a 3.4% dividend. So what do you do with the stock now that it's going to get bought out?
Well, this is what's another interesting thing about what's going on in the space, and that's that we have companies that continue to be acquired. Acquisitions have happened in the companies we own in the Hennessy Gas Utility Fund. AGL was they serviced about 4.5 million customers in Atlanta and in the Southeast region. And I think that adding this into Southern Company, Southern Company is getting a very good company that's performed very well for many years. And so if Southern Company stays in the index, we'll continue to own that stock as well.
All right. You also own Kinder Morgan, which has not performed very well this year. It's down 30% so far this year. Pays a nice 6.5% dividend. Can they keep that dividend up?
Yeah, well, that's the biggest question with Kinder Morgan, I would say. They have 80,000 miles of pipelines. It's a pipeline company, and they have 80,000 miles of pipelines moving natural gas throughout the United States. About a third of all natural gas moves through their system. They have a lot of their revenue is actually in long-term contracts. About 96% of it is either hedged or fee-based. Another 3/4 of that is take-or-pay type contracts, which means that cash flow continues. So when we look at the dividend, they're going to pay $2 a share this year. They continue to want to raise that 10% every year through 2020. And we believe that that's pretty safe at this point in time.
All right, and then finally, New Jersey Resources, ticker NJR. They own some renewable assets, pay about a 3.5% dividend. It's down around 5% this year. Why is this a good company to own?
Well, New Jersey Resources is a company, another sort of straightforward LDC. They do have other operations. They have the pipelines, they have the storage. They've done very well this year. In fact, they've increased their guidance 3 times just this year. They've raised dividends twice. They have a 22-year history of raising dividends. And they have a separate part of their business, which it's their wholesale gas wholesale services, which normally is about 5 to 10% of their earnings, but this year is doing very well, and they're looking for about a 25% of their earnings contribution from that one particular sector. So we think this is a good company to own long term, and there's still some very good prospects there.
All right, we're going to watch it. Thanks a lot, Ryan.
Thank you very much, Greg.
Thank you for watching The Street.